Yeah, hello everyone. Hope all of you are doing fine. Thank you for joining us today in our monthly webinar series. We had the Union Budget 2026 presented yesterday morning, and we've seen a lot of volatility in the markets, especially the equity markets. And over the last few days, we had seen a lot of volatility even in the commodities market. I'm very pleased to share that over this webinar, over the next hour or so, we have a very power-packed team to try and decipher on the various ways of investing through all asset classes, equity, fixed income, and commodities, and what is the outlook on markets for the year ahead. This was a very important budget for the markets because we were entering a space of a lot of global uncertainty, geopolitical tensions, etc. And there were a lot of expectations from market participants on what they believed can change the positive atmosphere for investing. I would say after the budget was announced yesterday, there was a slight disappointment from market participants, especially because of increase in STT tax, which led to a sharp fall, especially on the equity market side. But thankfully today, I would say market sentiments and better sense has prevailed, and market has seen a sort of good bounce back today. I am very pleased to say that I have got Gaurav Mishra joining in today for today's webinar. Gaurav has about 28 years of experience in fund management and research. Gaurav has been associated with Mirae Asset firm for more than 6 years, and he manages our Mirae Asset Large Cap Fund and Mirae Asset Focus Fund. He is also the head of equity and oversees the entire equity functions for the AMC. So thank you, Gaurav, for joining me today for today's webinar. So Gaurav, like I mentioned, market was maybe looking at some positive sentiments to come out from the budget. I would say compared to most of the global markets, Indian market had been a laggard for 2025, and the first half or the first month of January, we again saw a lot of outflows from foreign investors, which led to a sharp correction in the equity market in the first month. In the context of how the budget was presented, how do you look at the budget from an equity market perspective, and maybe the hits and misses you felt the budget provided for investors?
So good afternoon to everyone. In context of the equity markets, with reference to how the budget itself, see, I think this was a very, very positive budget. And I say that for a couple of reasons. First, of course, we have to acknowledge that we, have been living in fairly uncertain times, both
Sure.
from the geopolitical
Correct.
uncertainties, and also as far as India is concerned, with a fairly undue amount of tariffs,
Right.
for the economy and for certain industries which are clearly on the firing line because of that. So clearly challenges coming from a lot of global cues, and even there, lots of continued uncertainty there. So in that context, to me, the first thing I was hoping for was that macro stability is preserved.
Sure.
And through the budget, it comes from both, this continued path of fiscal consolidation and the quality of that consolidation, with the assumptions which have gone into it being, reasonable, if
Sure.
not conservative. And I think the budget sort of tick marked on,
Sure.
all those parameters. Having said that, the budget was also pro-growth.
Sure.
Because that clearly is the need of the hour for an economy like ours,
Correct.
where there is, scope, there's structural opportunities and growth has to be captured. And I think the budget did a good job on that front also. So if we reflect back, post-COVID, there was that huge spurt towards infra and capex. And then
Correct.
last year, there was a bit of a realignment to support
Consumption.
consumption through,
Fair.
GST cuts, through direct cuts, and later during the year through GST, etc. And there, of course, other reforms in labor which were done.
Sure.
So we were in a situation where the support to consumption has been provided. Now we have to see how that plays out.
Plays out.
We have seen some uptick clearly in auto, but we have to see how it plays out in other parts of
Sure.
the discretionary and other consumption. The capex side, of course, the government had been supporting capex in infra, and so the need of the hour was really to continue that part, again. And I think they have, picked that ball and kept running on the
Okay.
infra capex side.
Sure.
And how they've done it is that, last year they started off saying we're going to be targeting now more than fiscal deficit. We're going to be targeting central government debt to GDP.
Correct.
So what was, over 56.1%,
Correct.
is been targeted to come down to 50% plus minus 1% by
Correct.
FY31.
Correct.
So this budget, they have now reduced that, and there's on that glide path, bringing it down to 55.6 or therefore,
Yeah.
or thereabouts. What that means in terms of fiscal consolidation is that, we move from 4.4 to 4.3% of
Correct.
GDP. So again, why I make this point is that over the last 2-3 years post-COVID, when the government had expanded the deficits to a large, 8-9% of GDP, they have been on a contractionary phase, and
Correct.
rightly so. You can't have such high, deficits, but as you kind of reduce deficits, you are in a way contracting. You're giving a contractionary impulse to the economy.
Sure.
So we've had this growth of 6.5% with this negative impulse.
Correct.
This budget onwards, I think that negative impulse considerably slows down. It's just 10 basis point of GDP.
Okay.
And therefore, on the backdrop, we've had supportive policy on tax front, direct taxes, GST, labor, and now you're on the fiscal consolidation. Headwind is literally no longer a big part,
Sure.
and therefore, hopefully, all the efforts which have been put in the past few quarters should start, being visible, and therefore, I say that the budget is pro growth. And lastly, the nature of the deficit also. If we see,
Correct.
while there's a slight reduction of within 10 basis points, the nature itself is qualitatively getting superior.
Correct.
Even in this budget. So we are seeing that while the expenditure growth is about 8% in the budget, but actually expenditure growth on infra, capex, and those ministries and those headings is more in the band of close to 12%. I'm just rounding it up. It's 12%.
Correct.
Whereas revenue expenditure is about 7%. So 8 is the total expenditure, but the capex side is higher at 12, and the revenue side is lower at 7. That's important because the multiplier effect is most through the infra side, infra and capex. That has the biggest multiplier effect on the economy.
Sure.
And besides that, we've had, the public sector enterprises also projected to grow their capex by about 11.5% for next year. So therefore, the quality of the budget is also, improving, and it's pro-growth for the host of these reasons I have mentioned. And lastly, in terms of other takeaways, sure, there were efforts to also support employment, both the skills on the skill side through, the GCC is, the sort of clarity there, or through the medical, part of it through, support to, hospitals and all of that. And of course, otherwise, at the other end through, measures for textiles and tourism and all of that. And lastly on capex, if I missed out, is the fact that there is also, besides this headline, support on that of that 12%, there's support through, this concept of city economic regions. It's small to start with, but I think it can set the ball rolling. Support to tier 2, tier 3 cities. Yeah, and also of course those 7 high-speed rails network. Now that will not happen in one year; it will spread out over. But over a medium term, it does give visibility of capex in, say, rail, for instance, which anyway this year has seen a good, double-digit increase. But this gives visibility over the next few years beyond that. And lastly, of course, the global the data centers, where again there's been tax concessions, and that's been a big part of the capex, story elsewhere in the world, especially the US. So there are a lot of ingredients which are broadly in place for the Indian system as well to participate in that. And I think this tax concession should lead to more announcements and actually more capex happening under the data center. Yeah. So if you think of it, I think it's again, to conclude, fiscally prudent under the challenging environment we are in, very much need of the hour, and yet pro-growth.
Pro-growth. Fair. So, Gaurav, like you said, government in the past has been quite fiscally prudent, and the quality of fiscal numbers have seen an improvement. So do you think there is a risk to some of the numbers, whether it's expenditure, disinvestments in the budget, considering that that the global environment is quite uncertain? So is there a risk to some of the assumptions which are made, which maybe you would like to highlight?
No, I don't think. First of all, this the possibility of deficit targets not being met are also a function of the mindset of the government. And this government we have seen over the past many years is conservative, and then in what they give, they meet.
Correct.
So even this year, while they've for the year gone by, there were shortfalls in tax collections, but they eventually did meet their fiscal deficit target.
Yeah.
I think the same will play out next year.
Okay.
So of course, one is that on the expenditure side, the government has some flexibility to adjust depending on how your revenue collection itself is coming by, as the year progresses, both on the capex side and also on the revenue expenditure. But this time around, when you think of the revenue collection assumptions as well, on the tax front and otherwise, they are fairly reasonable. So this year overall tax collection growth is projected at 7%. It's the same magnitude as it was in the year gone by. That also delivered has been close to 7%.
Correct.
And even within the 7%, actually the highest growth is under the head of excise duty, which accounts for about 10% of the total tax receipts. That is projected to grow at 16%, which looks a bit strong. But then if we, reflect that the cigarette part of the system has had this huge increase in taxes, that accounts for it. But I could argue that if crude prices were favorable as the year goes by, there's scope to raise excise further through, raising duties on retail fuel as well, diesel, petrol, which has not been done so far. So there can be that leeway to the government. On the other hand, GST collection, which accounts for about 23% of the revenue on the revenue side, that is actually projected to degrow by -2% for the full year. Now, of course, there's that element of the rate cuts, but that will play out for a few quarters and then the base. I could think that, if the buoyancy in the system, in the economy comes back, then this could also surprise on the positive side. So net, I'm not, and the direct tax collections are at that 11-12%. I don't think those are too difficult to be reached. So at this point, I'm.
So you think the assumptions are all okay, and maybe one or two positive surprises could happen?
Could well happen.
Okay. Yeah, thanks, Gaurav. I hope one of the reasons market sort of gave them a thumbs down to the budget yesterday was because of the increase in STT, and both on futures and options. And Revenue Secretary sort of wanted to explain that a lot of retail investors have been investing in the F&O segment since the last 2-3 years. SEBI has come out with a various number of reports saying that 90% of the retail investors do tend to lose money when they trade on the F&O segment. And there was a request that how do we avoid speculation, get more people to move towards investments. And with that in perspective, they sort of increased the STT on futures and option segments. But do you think the increase in STT will have an adverse impact on F&O volumes, on overall equity sentiments from short to medium term perspective? Or I think so, maybe it's just a one-off thing that people will take in the stride and move forward?
Yeah, I mean, as investors and for all equity investors, this should be a 1 day or 2 days phenomenon, and it doesn't impact bottom up fundamental investing at all in whatsoever manner. So I think it's in that sense a non-event for investors with a medium long-term horizon. Maybe a day or 2 days there can be volatility on that count, and that actually is an opportunity for people to realign their weights if they are underweight as investors. To your question on volumes, see, I mean, earlier instances in 2023 and 24, whenever these STT has been hiked, didn't seem to have any impact on volume subsequently. This time around, maybe the base is higher, so there could be some, say, on futures. The estimates I have seen in different reports is anywhere between 0 to 15% sort of
Sure.
to volumes. I can understand that, for those who are trading with very thin margins,
Correct.
wafer thin margins where this STT hike does impact, that thin profit margin, especially the high frequency traders or, retail investors who are doing it on very thin. There could be some hit to the way they are going ahead
Correct.
with their trading sort of activity. But
Sure.
again, to conclude, I mean, to me, for investors, I don't think this would matter.
Okay. So you're saying for long-term investors, not too much from an investment perspective. And of course, I think the idea of equity investments is to have a long-term time frame. We keep saying that you should have a time frame of at least 3 years while investing in equities. So with that in perspective, hopefully STT is one of the small elements which should not impact the markets too much. Gaurav, we've seen that a lot of announcements usually happen during the budget, and government has kept saying that a lot of announcements they would continue to make behind the budget. So no announcements will happen and they don't need to wait for the budget to sort of come through. But considering that budget is a big event, a lot of announcements were made from a few sectors. Government also focused on a lot of new emerging sectors, on semiconductor, rare earth materials, focus on electronics, manufacturing. A lot of talk was there on AI, financial inclusion, and improving the banking system across India. In the context of the various announcements made through the budget, do you think there is a change that you would make in some of your portfolio strategies from an overweight, underweight call on sectors, or sectors which were sort of more positively impacted by budget, and some sectors which were sort of negatively impacted because of the budget?
No, we have in context of the budget, I don't see the budget itself having made any difference to our sectoral outlook,
Sure.
either pre or post the event itself. I mean, having said that, there was already some thrust given to consumption where we were present. We built our positions, and equally, I mean, we were present in select areas of infra, capex, etc. And the budget, thankfully, has just reinforced that the government has got a holistic view on all the drivers of the economy, the consumption investment side. So to that extent, that part we are broadly, taken, are covered. Having said that, of course, I mean, there's some parts, for instance, in the budget, like defense, where the capex has seen a very nice double high teens kind of growth in the allocation, defense capex in particular. So as a house, we are already present, but just given how the valuations are, I don't see us enhancing further weights given the valuation, sort of comfort, discomfort, if you may, in that space right now. But yeah, if there's volatility for some other reason in that, we could look at it. Similarly, and I'm as mentioning, the data center thing could be interesting, promising. There is already some exposure, I would say, but we would want to double down and further just kind of relook very hard from top down if there are some ideas which could emerge with a medium term perspective. Yeah, so there'll be some select pockets like that, but other than that, no major sort of overhaul on account of the budget.
Sure. So maybe, Gaurav, if you can reiterate for our investors and partners, what would be, as a fund house, our overweight few sectors and some of the underweight sectors from a short to medium term perspective?
Sure. So, I mean, currently we would be, say, we would be overweight clearly in the banking space. Yeah, that's one area. That's a big part of the index and the profit pool. And we think that the sector is getting, getting some tailwinds as we go by. We're seeing month on month, and not necessarily related to the budget, but courtesy the slightly better or better supportive monetary policy. We are seeing credit growth pick up, every fortnight. And hopefully, if overall economic momentum continues, we should have some good winners there. But I would just step back and say that for us also, a lot of the portfolio composition is bottom-up ideas, and not necessarily huge top-down sector overweight, underweight, calls. but at least this is one big sector where
Sure.
there's comfort. Then, I mean, in terms of underweight, we would be, while there is some traction, but we would be typically a bit underweight in consumer staples.
Okay.
Whereas, on the discretionary part, if I were to include automobiles on a bottom-up basis, depending on, what preferences of the respective manager, we would be
Overweight.
present in
Okay.
that category. Yeah, so that's that. We have been overweight in metals last couple of quarters. We would now have been, in the last few weeks, kind of or months, adjusting that as well.
Sure.
Yeah, so that's in terms of the bigger sectors. Then
Sure.
it's a bit more smaller sectors where we might be like telecom, etc., where we'll be overweight or niche ideas on the bottom.
Sure. So, Gaurav, one more announcement which was there in the budget was on buyback.
Mm.
And clarity on how buyback will be sort of taxed. And we've seen that over the last few years, there's been a change on stance on how buyback would have been considered. Now with buyback being taxed at 22%, or the tax rate being sort of fairly more better for investors, do you think it is positive for IT firms who usually do buybacks, or overall good for investors on clarity for promoters and investors as well? So how do you look at this announcement?
I look at it favorably. It's a real good announcement because I mean, not only IT but any firm should have an ability to decide what is appropriate in terms of its capital allocation or dividend distribution policy.
Sure.
And if there was undue friction, which was the case so far on the buyback front because of
Correct.
the way it was taxed, that was unfortunate. Now,
Correct.
for any firm or industry, in an industry where there is, surplus cash, lack of growth opportunities, or just very high generation, and valuations are, let's say, attractive to the management or promoters,
Yeah.
then, this is a better way of also, kind of allocating their, capital,
Sure.
for in that kind of setup. And IT firms could, well be beneficiaries. Of course, we know the bigger ones have pretty large payout policies announced in
Sure.
the magnitude of 80-85% of their
Correct.
cash flows.
Sure.
And this was a pain point, unfortunately. So now that gets addressed
Sure.
when you have the buyback tax rates more at the LTCG rather than the
Sure.
the earlier rates.
Sure.
So yeah, it should be supportive.
Sure.
And could even give a bit of a leg up to evaluations for firms, including in IT, which are going to be, candidates for using this as a
Sure.
capital allocation policy.
Sure. So Gaurav, we've seen that when we did the last webinar, we felt market valuations were quite reasonable and some of the pockets were looking interesting. We saw a good sort of correction in Jan, and considering the sort of correction, now I think the large cap stocks are also looking from the long-term averages trading at a slight discount to their long-term averages. So there has always been this concern in market that Indian markets were trading at premium valuations. I think so in the last 12-18 months, most of the global markets have done phenomenally well. India has not sort of done well. So the premium that India demanded has also sort of gone down. And in spite of equity markets not doing well, from a macro perspective, GDP growth and all, India stands out clearly as one of the best economies to be placed in. So in that context, how do you look at the various three segments of large, mid, and small from an allocation perspective? Which buckets make more sense? And which category of funds do you think would be the more appropriate ways to sort of look at?
No, I think the times we live in, I mean, clearly there's need to, have a proper asset allocation also. I'm just stepping back, given the bullet. And if there's some extraordinary gains made in other assets, what I'm hinting at, then there are times to reallocate it back so that you are at an optimum, level you've set out for yourself across the other assets, including equity.
Maybe actually equity was an asset class people went significantly underweight and significantly overweight commodities. And we have a session on commodities, we'll cover that. But I think you are absolutely right. That's a time to now rebalance the weights.
So as far as India is concerned, and in on a market cap basis, frankly, for investors with a medium horizon or long term horizon of 3 years plus, the India story is such that you want to be present across the large, mid, and small, because
Correct.
as we have been saying, that there's some sectors which are not adequately captured in the large, and there's
Correct.
some which are not captured in the small and mid, for which you've got to be in the large.
Right.
The large, of course, are typically stronger business models,
Right.
and therefore less vulnerable to economic shocks, and all of, or even some management vagaries,
Sure.
with better corporate governance and governance and all of that. So there's a need to be there across. Yeah, short term, because there has been an earnings challenge, for the markets.
Right.
But as we speak, there's reasonable comfort that earnings should be moving up into double digit. There's a lot of support from policy, macro stability, which should
Correct.
support all of that as we in the quarters ahead. And given the valuation comfort, sure. I mean, the large caps could initially hold up and do better, more in the immediate term,
Right.
especially with the global cues also. But for investors with a 2-3 year horizon plus, there's got to be need to be adequately represented across
Yeah.
all the three. Now, whether one wants to take the call, oneself, or with the advisor suggesting that such and such percentage between large, mid, and small, or one wants to do it through a multi-cap or flexi-cap, we can delve into that if you want
Sure.
to. I'll have my own views, but you've got to be careful that if you're going through just one flexi, then you're not, overly indexed to say large cap, because a lot of flexis tend to have
Correct.
a large
Correct.
share of, especially if that's a big chunk of your
Portfolio.
pool, and you're thinking of keeping it like that for 3 years, because
Yeah.
then you might miss out on the correction and opportunities with small and mid
Sure.
might be presenting in the right now,
Yeah.
or in the one side.
So essentially, you're saying from short to medium, large cap valuations look fairly attractive, and mid and small cap from a long-term view needs to have the right sort of balance in weight. So you need to have the right balance of across all these three segments, and you could play it to different categories of funds. Maybe one last question, Gaurav, before we let you go, is that we've seen that flows has been one of the challenges that markets has faced. So the domestic flows have been quite robust. The SIP flows continue to be the ones which are supporting market. Foreign flows have been quite negative, and especially the month of Jan, the trend sort of continues. Do you think that the trend of outflows from foreign investors might change in the second half of the year? And what would be the triggers for flows to enable markets to perform better?
Okay. Well, I'll just step back again. I'll make a point that to the extent we've not been getting flows, the markets are consolidating or are subdued. This is an opportunity for
Correct.
investors to get in, and for managers to be buying businesses which they're reasonably comfortable with, both on quality and valuation, more importantly.
Correct.
Otherwise, when all taps are open, it just goes.
You usually see that
Yeah.
businesses become too expensive.
Exactly. So
Good time to create portfolios.
Yes, exactly. So that's the first.
Right.
So this is an opportunity, really. I would urge and kind of reiterate. As far as triggers for FI inflows are concerned, if that's your question. See, sure. I mean, last 1 year, 1.5 years, earnings growth has actually been falling short of what was projected as the year started and as the year progressed.
Sure.
This time, I think it should be the reverse. There are enough cycles which I mentioned, which are supportive. And so the first thing would be that confidence in earnings trajectory coming back, that we have got into double digit. That should be one. Then secondly, of course, India has been a bit on the other side of the whole AI trade.
Correct.
Where global money managers are clearly seeing good returns on the back
Correct.
of that, whether it's in the West or even in the Asian economies.
Correct.
Because there are some places,
Yeah.
chip makers or
Yeah.
elsewhere, otherwise. So the money is clearly chasing that right now.
Absolutely.
That cycle is, of course, anybody's call, as in when it might pause, and
Sure.
there might be some modest, correction, time correction or price correction. I don't know how that will play out, but somewhere, if it, as in when it pauses, after all, valuations could get sort of exuberant also in that at some
Sure.
stage, related to the delivery of what is to be expected to justify that. Then that could be an additional.
Sure.
So a combination, I would think, of the domestic growth holding up nicely, valuations being comfortable, and just some pause in the AI sort of change
Sure.
which is underway elsewhere in the global economies.
Yeah. So thanks, Gaurav, for all your candid responses. Maybe we'll go to the next section, which is the fixed income section, and then we'll open the floor for more questions. And I'll come back to you.
Yeah. Thanks, Eric.
So thanks, Gaurav. So we had the equity view from Gaurav, and I'm very pleased to say that the next speaker that we have is Basant Bafna. Basant is head of fixed income and manages our fixed income strategies. Budget is a very key event, especially for fixed income market, because the budget looks at the borrowing numbers, they look at the fiscal deficit, what would be the gross borrowing, net borrowing numbers. So when we see the overall budget, and Gaurav had explained both the fiscal numbers as well, but a lot of positive announcements were also made for the fixed income market, especially for corporate bonds and deepening the corporate bonds. And no one better than Basant to sort of explain some of these elements for us. So pleased to invite Basant for this webinar. So thanks, Basant, for joining me today. So Basant, let me start with the first question. Maybe the good part was fixed income markets were closed yesterday. And we saw the equity markets had a fairly volatile day yesterday. And surprisingly, we thought they would correct today, and they sort of bounced back today. This is the first trading day after the budget for the fixed income market. So just wanted to understand, how do you assess the budget from a fixed income market perspective? Overall, how do you felt the budget was?
So I think it checks all the boxes that one could have hoped for in terms of the overall fiscal prudence framework that the Honorable FM had outlined earlier as well. In terms of the overall numbers, I think the projections are quite reasonable in terms of the revenue projections, expenditure projections. The government continues to front load capex, which is a significant amount of positive at a time when transmission has been quite slow.
Sure.
In terms of banks being able to transmit the rate cuts that have been undertaken for the large part of last year. In terms of market reaction, so there has been a tale of two sides in terms of the market reaction for SLR securities and non-SLR securities. So SLR securities have sold off by 5 to 7 basis points and is trading in the range of 6.75 to 6.77. But in terms of the non-SLR, given that the spreads are extremely attractive, they have held quite well. Okay. Especially as RBI has continued to infuse liquidity. Overnight rates have seen a sharp sort of fall. Repo is at 5/4. We are seeing overnight rates sub 4% today. Given that is the case, the spreads have become very, very attractive. So with 1 year levels at close to 7.10 and the NBFCs sort of trading at a spread of 30 to 40 basis points, AAA NBFCs. So from that perspective, we are seeing a significant amount of additions to that. Given that the fiscal worries are behind us, the government continues to be proactive in terms of being able to manage the fiscal sort of numbers. So they have given a glide path as well of 50% debt to GDP by 2030-31. The fiscal deficit for the next year also has been reduced from 4.4% to 4.3%. They've been able to manage the 4.4% this year as well. Yeah. One key sort of expectation that the market had. So, the net borrowing number is at 11.7, gross is at 17.2. So one expectation that the market had was that, the gross borrowing may be a little lesser, given that, the RBI the government would undertake some switches or do some buyback that they had done last year. But, they've not announced any buyback. Perhaps, once the policy space opens up over the coming year, perhaps that is something that we look out for. And switches, they've looked at the shorter end securities beyond 27. So that doesn't appear in the gross domestic borrowing adjustment. So overall, it's been a sort of good budget in terms of fiscal prudence. Markets are showing a knee-jerk reaction right now, but overall demand supply dynamics, on the non-sovereign side, seem to be now consolidating at a level where asset managers as well as insurance companies, pension funds, they are looking to buy. So that's the sort of key takeaway from the budget from my end.
Sure. So, Basant, you said, you felt the assumptions are quite realistic on fiscal. And in the past, the government has been able to show that they've been able to manage fiscal quite well. Um, at the current sort of yields which are there between short term, medium term, long term, how do you think are the various segments looking, and which segment is sort of looking quite attractive from a fixed income market perspective? And do you think the government borrowing will have any particular impact on any particular segment of yield curve?
Let me move from sovereign to non-sovereign. In terms of sovereign, I think the devolution of to states have been kept at 41%, and because of that, all of the policies that are being announced at the state level, they are having an impact of 70-30, in terms of 70% being borne by the states and 30% being borne by the center, whereas the devolution is at 41%. So
Sure.
there might be continued pressure in terms of spreads between sovereign and
Okay.
or GSEC and SDLs.
Okay.
But in terms of the non-sovereign side, I think the curve has massively flattened over
Okay.
the past 6 weeks or so,
Hmm.
and that presents a very good opportunity because given that repo is at 5-quarter, 3-month levels are at 200 basis points over and above repo rates. And if
Correct.
you go back in time, I mean, yields had in March, wherein you were at massive amount of deficit in terms of liquidity. At that point of time, also with overnight rates at close to 6.5% in March, yields peaked out at 120, 130 basis points over
Correct.
overnight rates, and today we are at close to 200 basis
Yeah.
points over repo rate. So from that perspective, yields are extremely attractive. The key question is, how severe the supply continues because of elevated CD ratios. But I think at this point of time, yields are looking extremely attractive on the non-sovereign side. So with the curve being very flat, so 3 months, 6 months broadly flat, and 1 year being a little inverted by 10-15 basis points, there is a clear indication that markets are giving you that spreads are extremely attractive, and therefore markets are adding longer duration in the money market curve. On the
Sure.
corporate bond curve also, then it derives from the money market curve. So 1 year CDs versus corporate bonds, 1 year, 2 year, 3 year, sort of in the 15 basis points range, and then 4, 5, another 5 to 10 basis points. So from that perspective, the curve is extremely flat. We like the 1 to 3 year part of the curve the most, because when you move post quarter end, that part of the curve will see the maximum amount of transmission. But obviously, investors should look at their overall investment horizon before allocating funds. So what I would look at is that, say, for example, if your investment horizon is 6 months, then you look at a product which has a duration of close to 6 months or so. 6-month investment horizon, look at a 1 year product, and so on and so forth. Because overall, you look at the FD rates. So 1 year FD rates broadly are closer to 6.25% for top tier banks. Your 2 year FD rates are closer to 6.45, whereas mutual funds in the same category is offering at least 50 to 75 basis points higher yields as compared to comparative FD rates, with the possibility of capital gain pass on when you start seeing spreads compressing.
Sure.
So that's the sort of view that I have.
Sure. Thanks, Basant. So I know since you are covering on corporate bonds, there was a lot of positive announcement in the budget on increasing the corporate bond depth, market depth.
Yes.
How meaningful do you think the announcements were? And do you think this will help improve the liquidity in the overall system? Maybe if you can share your thoughts.
Sure. So to start with, I don't think it will improve the liquidity immediately. It perhaps caters to more to HNIs and investors who deal in smaller sort of quantums overall, because markets are quite decently liquid for higher quantum sort of
Correct.
trading volumes. But what happens is that when you are looking at buying a smaller quantum rather than deploying say a small amount, say 50 lakh, 1 crore in an FD, rather than that, if you look at buying a corporate bond, because corporate bonds are available say at 50-75 basis points spread over corresponding FDs, at that point of time the market making activity is extremely muted, because of which price discovery, you take a significant amount of it. So if there is a market making activity, those entities, those individuals who would like to deploy directly in corporate bonds, they would get a massive amount of benefit because of price transparency.
Sure.
So from that perspective, it is a good step in the positive direction. The only thing is that at some point of time, once you start seeing that sort of transparency in terms of volumes, it has a good potential to sort of take off. You've seen RBI do the same thing already with RBI Retail Direct in terms of sovereign securities, and now this takes one step forward in terms of corporate bonds.
Sure. So after the, allowing retail investors to move to the government segment, did we see sort of huge change in liquidity? Has there been, in your estimate, a sort of improvement there?
So the liquidity, not so much perhaps, because government security markets are already very
Fairly liquid, yeah.
fairly liquid. But in terms of price transparency, yes.
Sure.
The differential in what the market levels are quoting at and what a retail investor gets, there was a huge
Sure.
amount of differential
Sure.
earlier. That has sort of bridged significantly. The same is expected out of corporate bonds as well. So once you start seeing market making activity on screen available to investors, at that point of time, you will have more and more of transparency.
Sure. Fair. So Basant, I think last webinar which we did, which was our sort of annual outlook for 2026, you had mentioned that one of the key advantages that the fixed income market will get is the addition to the Bloomberg sort of index, and that will sort of help bring foreign flows. We've seen that the foreign flows for equity have been sort of quite muted. In fact, we've seen continuous amount of outflows, due to which also the currency has been negatively impacted. How do you think the foreign flows have been on the fixed income side? And with the Bloomberg index move happening in a few months, how do you think that can be positive for the fixed income market?
Sure. So barring, I think 1 month, I think last month, across, I mean, fixed income has not had the kind of severe impact that equities have had. So you've had positive flows generally for a large part of last year, and we've not seen a significant amount of negative impact, barring that 1 month wherein we saw some outflows. Overall, carry remains attractive on the fixed income side, and we've not seen any amount of massive sell-off. Now, in terms of the inclusion in the Bloomberg Barclays Global Aggregated Index, the index tracks close to $3 trillion, which is applicable for India. Our weight is expected to be in the range of 0.7 to 0.8%. So that brings in close to $24, $25 billion worth
Correct.
of flows. So now, in absolute terms, it looks at around $2.2 trillion, which is close to 20% of our annual supply.
Absolutely.
Net supply. So, which is quite significant, because then it reduces the kind of burden that RBI would have to bear to manage the overall supply for the year. The second key part in terms of the demand supply dynamics is that last year we had this change wherein the equity allocation for long only funds had increased from 15% to 25%. Now, because of that, a large part of their allocations incrementally had gone to equity and not to the fixed income market at all.
Correct.
The understanding that we have is that a large part of that has been filled. So the overall allocation now stands at close to 23 to 24%, which essentially means that incrementally there is not much space to divert funds from equity to debt, and therefore incrementally whatever flows would start coming in, you would start seeing that getting deployed in the longer end of the curve. And that's why you've seen that over the last, say, 5-6 trading sessions, barring today's session, you've seen continuous amount of flows sort of trickling in into the longer duration, even as the benchmark 10-year yields have remained range bound. So that is the first sign that we've sort of started seeing.
Sure.
Once we start seeing a sustained sort of move in terms of demand being extremely strong, we'll give out that call when the time is appropriate. But
Sure.
we've started seeing the first signs.
Okay. So Basant, one question that I had was, in the sort of current market scenario, we've seen that STT has been increased on futures and options segment, and there are a lot of news saying that arbitrage fund category could have about 30-40 basis points of impact in the returns because of the increase in STT taxes. This would mean that the spread that arbitrage funds had compared to some of the fixed income category funds would go down to that extent. Do you think in this scenario more sort of funds flowing to the fixed income categories, at least maybe the 3 month to the 6 months tenure products because of this? And how do you position your products in that sense?
So generally, the rule of thumb is, arbitrage category sort of looks at closer to maybe 70 to 100 basis points over liquid funds. And, if that sort of reduces massively, say by 40 basis points or so, the incremental advantage that you have, barring the taxation benefit in terms of absolute returns would dip significantly. And in the current scenario, when, you are looking at spreads being very, very attractive, debt funds look extremely attractive from a overall return perspective from a 3 to 6 month investment horizon. So from that perspective, I think on an absolute basis, it looks extremely attractive. And from that perspective, in the 3 to 6 month investment horizon, investors should look at, say, ultra short duration as a product or a low duration as a product, because that has the potential to sort of give significant amount of capital gains going into the next quarter when, the demand for credit, related flows will not be very significant. And at the same time, liquidity will go continuously in surplus.
Yeah. So Basant, like you said, arbitrage funds have the tax advantage. So that naturally is an advantage those category of funds will get. But now some incremental allocation can also move to fixed income because the yields also are quite attractive. So it's a good time for investors to look at rebalancing their allocation. Maybe you touched on it in the previous questions. But maybe one last question from my side before we take questions from the audience on fixed income as well, is that in the current scenario, which is prevalent, which are the fixed income categories which you feel will be the most appropriate investors could look at? First, with a sort of short to medium term perspective and maybe a slightly longer term perspective.
Sure. So from a investment horizon of, say, for example, 3 months, if you're crossing March,
Sure.
you should look at, say, ultra short duration or money market as a category. If your investment horizon is, just for meeting your liquidity requirements, not crossing March, markets can be quite volatile between now and March as well. So you should not go beyond liquid as a category. But if you're looking at a replacement product, say, for example, as against a 1 year FD, if you are a conservative investor, you should look at low duration as a category, which then sort of matches your investment horizon with the duration of the fund. If you are a bit of an aggressive investor trying to take benefit of the attractive spreads that are available, then you look at short duration as a category, as against some other categories wherein, you have restrictions related to allocation between corporate bonds and sovereign bonds. Here you get that flexibility of reallocating your overall funds between a corporate bond or a certificate of deposit or, say, for example, a sovereign bond. So right now, for example, when yields are quite flat, generally historically certificate of deposits have had a spread lower. It's been trading lower as compared to corporate bond by 15 to 20 basis points. Right now it's closer to flat. So
Sure.
then you can reallocate your sort of overall holdings between from corporate bonds to certificate of deposit. So this sort of category gives you that advantage of flexibility. So if you have an investment horizon, say 1 year or more, then you should look at short duration as a category. But otherwise, then depending on the nature of your investment horizon, so like I mentioned, so less than 3 months, so not March crossing, liquid, 3 months ultra short or money market, and 1 year, closer to 1 year, 6 to 9 months or above, you should look at low duration.
Sure. So thanks, Basant, for sharing the fixed income outlook and how to sort of invest in the fixed income market based on how the events have planned over the last month or so. And hope to connect with you in our next monthly webinar series as well.
Sure.
Thanks, Basant.
Thanks.
So the Union Budget 2026 didn't have much to discuss on commodities per se, but the commodity market has seen significant amount of volatility, especially in the last week or so. To try and decipher outlook on commodity segment, especially on gold and silver, which are the two asset classes which have done phenomenally well, I have the opportunity to invite Siddharth Srivastav, head of ETF products, as well as fund manager for some of our offshore funds for today's discussion. Siddharth has been associated with Mirae Asset for the last 7 years, and he will be able to give his perspective on the commodities markets, which I am sure all of you might have a lot of questions on. So thanks, Siddharth, for joining me today. And like I was saying, maybe the budget was not an event which would have impacted the commodities market too much, but there's a lot happening in the commodities market, especially over the last week or so. So maybe I had a few questions which I sort of wanted to ask you, and would request you to sort of cover that. So gold and silver has had a phenomenal run, especially over the last 1 year. However, we've seen a sharp correction both in gold and silver.
Correct.
And the sort of correction both in gold and silver has started to happen from Friday in both these asset classes, which had seen sort of huge amount of flows into them. So what do you think led to the sharp decline and profit booking in gold and silver?
Correct. So first of all, thank you, Weber, for having me here. And I'm happy that there was not much update about gold and silver in the budget. It would have just added to the complexity of what is already going on in global commodities market. See, we have been talking about it since past couple of months that initial rally in gold and silver were driven by fundamentals.
Sure.
In gold, we are talking about de-dollarization, which has happened post Russia-Ukraine war. People
Sure.
have started trusting US treasuries less. Obviously,
Central
Tra-
bank purchases.
correct,
Yeah,
central bank
which was very
purchases.
strong.
The fact that investments flows in last year has been around 800 tons.
Correct.
And then the fact that there has been continuous escalations of geopolitical issues, trade wars, wars in general,
Sure.
which we have never seen in decades before.
Absolutely.
And all these things were driving gold prices. Silver, on the other hand, always had the fact that it's a both precious metal, which is on the side of jewelry, which is used as an hedge, but also it is an industrial metal, right? We have
Sure.
been talking about that silver is in deficit since last 5 years.
Sure.
Last year, expectation was that supply was around 1 billion ounces, whereas the demand was 200 million ounces plus. Hence, price appreciation is bound to happen.
Correct.
So gold and silver both rose, and I think there was much justification about both rising to the extent it did till some part of last year.
Okay.
But then both commodities started a run which sorts of started going ahead of fundamentals.
Okay.
And that is when risk
Towards more liquidity driven.
more liquidity driven, yes,
Yeah.
more speculation driven, because especially in case of silver, the market is very small. And we saw that speculative trading, positioning on futures exchanges like COMEX, etc., even in MCX were significantly higher, and in a way, investors and volume themselves were driving prices higher and higher, which
Correct.
became hard to justify, especially in case of silver. Gold also had a run which was very quick from $5,000 to $550. So let's look at what drove gold very quickly. One was obviously the fact that there was speculation that Trump may announce a governor which market may not like. There may be negative impact on dollar. There might be escalation in US Iran, and that drove dollar too far too quickly at towards 5,500. Whereas silver, I think it was purely driven by speculation and it touched 120. And I think this correction was bound to happen. We have been cautioning on silver since quite a while. Even in our fund of fund, we have trimmed position on silver by a reasonable amount. Gold is something which obviously also had ran up. So correction has happened in both the commodities, more so in silver, less in gold. If you want, I can just talk about a couple of price points which are important. So gold touched all-time high of $5,595 on Thursday itself,
Okay.
and corrected very sharply to $4,894 on Friday.
Okay.
Right?
That's a huge.
Yeah.
volatility.
And today also there was huge volatility. Today, gold in international markets touched 4,400 and right now was trading around 4,700. So $300 movement in a single day. In fact, if I'm looking at price corrections. From high, gold has corrected to 21% if I'm looking at $4,400 level, but now it is trading at a 15% correction.
Okay.
Silver, on the other hand, touched all-time high of $121, went down to almost 71.38,
Yeah.
which is a drop of almost 41%. And now it is trading at roughly around $81.70 and 81.70, which is a correction of almost 32.8% from its all-time high. So gold is down around 15.7 and silver is down around 32.84. Having said that, and I know I'm taking a bit long to answer,
Mhm.
after a fall of 32.8%, can you tell me what is the YTD return of silver? It is still positive,
I'm not surprised.
1.3%. 3-month return of silver is still positive at 52%. 6-month return of silver is still 105%. And 1-year return of silver is still 140%. Same in case of gold, YTD it is still positive 7.6%. 3-month 20% almost, 6% 45%, and 1-year 72%. So
Sure.
even after this
Sharp correction.
sharp correction, if I ask someone, just forget about 2 days. Imagine that you woke up after 2 days and or a month
Yeah.
and had this returns
The other
that have been
returns are quite
promised,
impressive.
everyone would have been happy. But
Yeah.
yeah, here we are talking about such sharp corrections after this parabolic move.
No, absolutely. But one question, and Siddharth, you covered a lot of index levels and values. But when it comes to gold and silver, people only understand value of gold and silver in INR terms.
Yeah.
Some of them look at prices on the MCX exchange. Some of them look at ETF pricing. And we've seen there is a huge deviation in MCX pricing, future pricing, ETF pricing. How can a retail investor or a distribution partner understand what is the right level for gold and silver,
Correct.
and what is causing this sort of large deviation
Correct.
in prices between these asset classes, both on ETFs as well as on the international markets?
Correct. So typically when it comes to India, people usually talk in parlance of MCX futures,
Right.
right? Whether something is trading at an discount to MCX futures or a premium to MCX
Correct.
futures, right? But what has happened in last few days, that there has been some dissociation between what is happening internationally in terms of prices and where we are in terms of prices. Because see, we need to understand that in India, gold and silver can quote at a different level than what it is quoting at an international level,
Correct.
right?
Correct.
Because we are importers and domestic supply and demand causes this premium and discount.
Sure.
So, for example, today itself, silver in spot was trading at discount to international prices.
Okay.
When I was looking at the terminal, when international prices were around $81, the quotation of ETFs were around 10% lower.
Wow.
Yeah. There was also similar discount in gold also. Internationally, we're seeing fluctuation from 4,400 to 4,700. In India, there was a discount of almost 3 to 4%. Now, this can turn around and convert into a premium also, right? So what people typically ask, that why international returns are not what we are getting in domestic ETFs. So the thing is that domestic ETF tracks domestic prices.
Sure.
Premium and discount is a big thing. It can move from
Yeah.
few
discount
dollars
significantly.
to significantly high number also. So I think what people can do, and this become a bit mathematical, is that they can use the international number that's in ounces,
Correct.
convert it into
Yeah.
kg,
Correct.
basically then convert it into INR, then add the custom duty, and then that will get
I'm
what.
sure there will be enough calculators helping
Yeah,
investors.
possibly, yes.
Sure.
I'm sure that if they want to sort of benchmark what is the domestic spot versus what is the international spot based on the conversion, they can look at
Sure.
the live rates from IBJA publishes live rates
Sure.
on their websites also. So that is what I want to clarify, that ETFs track physical spot price of domestic market. MCX futures is completely different. It can trade at a premium or a discount, what we call
Sure.
tango or a backwardation. And international prices are something different. So it's a accumulation of everything. It's a bit complicated, but having
Sure.
said that, people can use these simple conversions to arrive at a benchmark prices for comparison.
Sure. So Siddharth, since we are sort of discussing a lot on budgets, was there any specific thing in the budget which did impact the commodity segment of gold or silver investing? And I think so there was a reference that, investors who bought the sovereign gold bonds would now be able to only get the capital gains benefit if they were to redeem with the RBI and not through the exchange. So maybe if you can cover few elements which were in the budget which impacted the commodity market and especially the sovereign gold bonds.
Yeah, I think you have already mentioned what in terms of taxation is going to happen in case of SGB. I think that clearly creates one more advantage for ETFs, right? For STCG that is based on a tax slab, and LTCG is obviously 12.5%.
Sure.
For fund of funds, though, the LTCG tenure is more than 2 years. For ETF, it is more than 1 year itself. So for
Correct.
ETFs is more beneficial, and ETFs provide liquidity, right? While people have been sorts of complaining about the fact that ETFs have traded at discount or premium, but the fact of the matter is that if somebody is tracking physical jewelry market, people have actually struggled to sell or purchase silver bars from the shops itself,
Sure.
right? So that sort of stress we have not seen in ETFs, and liquidity is continuously there. I think if you add gold and silver, right now on an average, you are seeing liquidity in tune of 9,000 to 10,000 crores on a daily basis.
Sure.
So I think and one very interesting thing is you can use ETF for trading also. For example, today,
Margin you're saying.
yeah, I mean,
Yes.
for example, in silver, the domestic prices went as low as $67 in terms of corresponding to the international markets.
Okay.
And then it moved up and closed around $72, $73. So intraday movements were also significant, both in silver also and gold also today.
Sure.
And I think while we obviously talk about long-term investors, what we are also increasingly seeing is that people are using gold and silver ETFs for trading purposes also, right?
Sure.
For intraday, etc.
So basically you're saying that SGBs have the disadvantage that you cannot buy and sell.
Exactly.
And you should just hold till maturity. That's where ETF becomes that more attractive, that you can sort of trade them, and that creates the liquidity for you as and when you require.
Absolutely.
Fair. So thanks Siddharth for covering that. I know it's a tough question to ask. Going forward, I know we've seen a lot of volatility, and you mentioned that in spite of this volatility, gold and silver have given sort of handsome returns. What is the outlook for gold and silver?
Yeah.
And how should you approach investing in gold and silver from now?
Yeah. So while we have been talking about gold and silver together, one should realize that both are very different in
Asset
terms of their
classes.
behaviors,
Yeah.
right? They both are precious metals, but they behave very differently. I think
Correct.
last 1 year is, and this last 2 days is example itself. Silver rose up by 140%, gold only 72%, but silver fell by 41% when you're comparing to all-time high to recent lows, and gold only 21%.
So maybe like 1-to-2 ratio it looks
Yeah,
like.
exactly. Double the rise, but then double the fall.
Yes.
So people have to accept that silver comes with significant volatility because it does not have a very huge asset base, right?
Sure.
It is compared to other asset classes. So I think from a risk reward point of view, gold looks better as of now
Sure.
because I believe that we have already seen 4,400 levels today, 46, 4,700 levels right now. Gold will have a sorts of a lower drawdown because of central bank buying and it being one of the asset classes where we are seeing institutional buyings, etc., etc. So I think from a risk reward point of view, gold is much better placed. Silver, like I said, that it will continue to have very higher volatility. It may give you some opportunity in terms of trading,
Yeah.
but it will continue to have higher risk. So between gold and silver, from a risk reward perspective, prefer gold, but probably trading opportunities will be more there in case of silver ETF. If you are, we also have gold and silver allocator. So what we are doing there is that we already started cutting our silver exposure a while back. So right now our exposure in silver is somewhere around 36% or so. Remaining
Yeah.
is in gold. And I think as of now, we are comfortable with having excessive gold. So we'll tilt towards gold based on the current scenario.
Yeah, so Siddharth, my next question was going to be that only, that for retail investors to understand index levels and when should be the right time to over allocate or under allocate to gold and silver is quite difficult. In that sense, what would be an easier way
Yeah.
for them to allocate? And I think maybe you covered in some part of your discussion about your gold allocator. Maybe if you can highlight some more advantages the gold allocator gives or some features, it will make it easier for investors and partners to understand how this sort of product can be used to create a better asset allocation strategy towards gold and silver.
Sure. So gold and silver allocator, what we have is while the benchmark is 50-50, we can take dynamic calls. So for example,
Okay.
we can go as high as 90% in gold
Okay.
and have only 10% in silver, right? And what it gives us is the flexibility that wherever we are finding better risk reward scenario, we'll
Yeah.
tilt towards that. So while this fund was launched in second half of last year, we were having a bit higher allocation towards silver, but in recent past we have shifted towards gold because of better risk reward scenario, and that has played out well in last couple
Sure.
of days. And I think for someone who wants to take exposure in just precious metals, this is very good because all the churning is not creating tax incidents for investors.
Okay.
If investors like you or me would have
Buying
done
and
this by
selling.
themselves,
Yeah.
selling of silver would have created a tax incidence, right? And if you
Sure.
were sitting at a gain of 150%, etc., that could have been a substantial amount. So that sort of thing is avoided when you are investing in a gold, silver
Okay.
fund of fund. Let the fund manager or the scheme take the allocation call and absorb the tax incidences, etc. So unless until you are very sorts of keen tracker of silver market and you can take those trading calls, etc., then obviously go ahead and invest in silver. But if you're looking for investment in both gold and silver, in a sorts of a where you take advantage of both in a
Yeah.
risk averse manner, a better
Yeah,
tax
like we always say, good asset allocation mix, then this
absolutely
allocator makes
makes
right.
much more sense. So if I have to suggest right now among all the three products which you are managing on the commodity side, gold, silver, fund of fund, gold and silver, my first suggestion will be gold, silver, fund of fund because it gives us the flexibility because it's been just 2 days since
Right.
this entire situation has started to unravel. We may see further volatility.
Sure.
So hard to say anything right now. Second will be gold for better risk reward scenario, and third will be silver. I think it will give opportunity for tactical plays for intraday
Sure.
activities, but that is the third suggestion as of now.
Sure. So thanks, Siddharth, for giving a perspective on the commodities market. I know we have a lot of questions in the chat, so we'll try and take some of the questions. So since Siddharth, you are here, let me start first with a question on commodities. So this is a question from Bala R. Given that silver spot prices haven't fallen as much as the paper prices fell, do you believe that silver prices will rebound back quickly? As the paper market prices fell, I'm not too sure what that means, but do you think there is a rally in silver expected?
No, so I think today situation has normalized, Vaibhav. What happened on Friday? The MCX spot was around 3 lakh 33,000 levels, which was significantly higher than where international prices closed. And on Sunday, during the budget day, there was no spot which was declared by MCX, but IBJA priced it. So we used IBJA prices for our NAV calculations, at least on the silver and gold side. And today, I think that spot prices, in a way, has converged. Even I was telling you that it has, in a way, gone to a discount compared to the international prices. So the aberrations which we saw in on Friday and then on Sunday is no more there on Monday. See, people need to understand one thing, that commodity market goes on after India market closes. It runs into London is a major center.
Time gap, time difference.
So if, for example, $85 what silver is, $81 what silver is right now, if when US market close it goes down to 70, it doesn't mean that India market is not pricing it. It's just that when India market was open, silver was at $81. When US market close, it was at $71. So more of a timing difference, but that is not the case. At least today, silver was quoting at a discount compared to international prices.
Sure. So thanks, Siddharth. Let me ask the next question to Gaurav. There's a question on the equity side. So, Gaurav, the question is that, Mirae Asset has just launched an infrastructure fund maybe a couple of months back in the month of December. And even in this budget, there has been a lot of announcements for CapEx and infra. Can you share more insights on what were the announcements made in infra sector and what would be the outlook on the infrastructure sector from short to medium term perspective?
Sure. See, the outlook on infra historically has depended a bit on the government's intention towards that space. Thankfully, what we are seeing now is that the government is steadfast in its support for the infra sector. So while I hope you can hear me. So
yeah, Gaurav, we can hear you.
I'm still okay. So post-COVID, just to refresh, there was a huge spurt, of the magnitude of 25-30% year-over-year growth of budgetary spend towards infra and those ministries. But even after that, the government is clear that they want to sustain it at least the current levels of about 3.1% of GDP. This is, of course, as far as the central government is concerned. And I think they realize clearly that there is, a fair amount of positive multiplier effect on the economy. This is the most productive part of government spending which can be undertaken. So it's really the best thing to happen. So I would think that in a worst case scenario, that given whatever is the nominal growth assumptions one has on the economy, I would say let's put it around 10%. I would think this head of infra capex spent by the government, central government, should continue at least that level. This year, frankly, it's actually higher. It is at about 12%. And as we were discussing earlier, that the public sector units themselves have an additional, 11.5%, spend growth on what was done last year. So I think that thrust is going to sustain for a few years at least. India, of all the things, is deficit on a lot of these infra areas, and there is a huge impact on other aspects of the economy. So whether it's exports or on urbanization leading to further employment in the services sector, shifting of GCCs. Manufacturing and being part of the global supply chain. So all of that, for that you require the adequate infra, whether it's evacuation through ports, through airports, rail networks, high-speed rail networks for, passenger movements and all of that. So I think this is going to stay. And really, what are the beneficiaries? This does change with time, so that we have to keep on tracking. This budget, the highest spend was, say, increase in spend was in defense, at about 18%. But fair, I mean, that has its own linkages with a bunch of private sector and PSU entities who are, increasingly participating in that Make in India. So the good thing is that more and more of defense, capital items are now being made in India. So there's that whole benefit to the Indian ecosystem, and I see that persist for years ahead. Then I think after that, the bigger increases percentage-wise were in railways, followed by highways and all of that. And so, of course, then one has to, drill down and identify bottom up what are the, sort of the stocks or sub-industries, which could benefit. So I think this is, here to stay for a long while. As I was saying earlier that, besides just this, the budgetary announcements, under these ministries, the mention of high-speed railways on 7 networks, which will be done over the next 4-5 years. So that gives medium-term or the support on tax incentives to GCCs to data centers will also have its own nuances in terms of beneficiaries. And I would think that with the AI phenomena at play, capital spending on data centers, both by Indian firms as well as global, firms, majors, is should sustain for some time at least, no matter what the vagaries of the stock prices might be. So I mean, whichever way I'm looking at it, I think of urbanization, which is again a driver of growth. And therefore the need for spend relevant to tier 2, tier 3 city upgradation, where the government is allocated something, or even the concept of city economic regions. Under all of that, there would be benefits. So it's got to be drilled down, of course, but it is fairly widespread. There's some pockets, if I have to mention, of areas of concern. For instance, in the budgets, when announcements are made, there's some heads or some expenditures which don't materialize in the manner envisaged in the budget. Maybe there's some physical constraints, or maybe there's some other challenges which come up as the year progresses. So this year, for instance, the year gone by, on Jal Jeevan, on the water mission, which is also spending on pipes and water-related infrastructure, there was huge shortfall on the expenditure there, of the magnitude of literally 20-25% of what was budgeted was spent. Now in this budget again, it's revised to that match. So in terms of percentages, a huge jump. But can I thumb the table and say, okay, this has got the biggest jump and we should see activity? It's possible, but there were some constraints in the last 1.5 years to do with inefficiencies, if I may. There were the issues of corruption, all that. So those are hopefully being looked at, sorted out, and we can see a restart on that head again. So that could be very promising if it is undertaken in the manner envisaged in the numbers at least. So therefore, with everything we have to kind of monitor, track, but the promise is very much there, because I think policymakers will realize that for economy of India's breadth and magnitude, you need all engines, and these are big ones, the infra capex and the consumption part to kind of be firing. Lastly, of course, is the private capex. Is not related to the budget, but there, the sense is, for instance, we see order awards in recent times. That has also started picking up sequentially, and we're hearing some of the capex private MNCs who have capital, in the capital goods space. We're seeing that they're seeing signs of traction in private sector, capex outlook also spread across, some big sectors like metals, but also then, the other basic ones where there's huge amount of debottlenecking going on in automobiles and all of that. And lastly, if I have to, I'll just make a point that we still have to be a bit, guarded on this, because the third leg of capex is actually done by the state governments. And while the central government deficits are in control and healthy, I would say, with the state governments, last couple of quarters, there's been a tendency to be spending money on the those freebies and all that. Yeah. So there is some kind of diversion of resources. So we have to see how that momentum from the state government side also continues. I think it shouldn't be completely taken. It shouldn't completely go off the rail, so to say, even from the state government side. Post the spending on some of the those freebies, I think the rest, and with the incentives being given by the central government as well to sustain capex, that should also sort of be contributing to the overall cycle. So I hope that answers how
Yeah,
I'm thinking about
yeah,
it.
yeah,
But it's going to be very
yeah,
bottom up, So across any industry, it's going to be bottom up, and you got to be watchful as well.
yeah. Thanks, Gaurav, for that candid reply. Next question from Mr. Shakul Gupta and Basant, if you can take this question. His question is, what is your view on the bond market, considering there has been an increased allocation to net borrowings? And he says that yields should move higher from where they are. Should an investor keep his allocation in short-term debts or debts up to 2 years only? Maybe if Basant, you can take that one.
Sure. So in terms of market movement, like I mentioned in my initial remarks, the market movement has been varied between corporate bonds, certificate of deposit markets, as against the sovereign debt market. So while the sovereign debt markets have seen a sell-off of close to 5 to 7 basis points from Friday close, corporate bond markets have held up quite well. So I mean, there is no major movement that we have seen on the corporate bond side, and that is primarily to do with the overall spreads that are there. They are very attractive as compared to previous March levels as well. And from that perspective, I think you should hold on to, if you're looking at short duration as a category, I think you should hold on to that category given an investment horizon of 1 to 2 years.
Okay. Thanks, Basant. I know there were 3-4 questions from Mr. Shakul, from Mr. Mukesh and Mr. Manoj on what would be the impact of STT or increase in FNO on the returns of arbitrage equities, savings funds, etc. So, let me take that question. So, all of you know that the STT rates have been increased on the FNO segment. Most of us don't trade in the option segment. We trade mainly on the future segment only. We had tried to do an internal analysis to try and figure out what would be the impact on various types of hybrid funds. So what we figured out, the largest impact, of course, remains on the arbitrage funds, because arbitrage funds tend to have at least 70% or more in future segment, and they run mainly hedged portfolio strategies. In that place, we've seen that funds typically will take about a 30-40 basis impact because of the increase in STT. For categories like aggressive hybrid, in most cases, aggressive hybrids invest at least 65% in equities, and hence, the arbitrage portion is really small. In that case, maybe not more than a couple of basis impact on aggressive hybrid. So aggressive hybrid category does not get impacted much at all. Even categories like BAF and multi-asset, where maybe we can say from our side, we typically run 50-55% sort of positions plus minus 10% based on valuation models on PB, PE basis. We don't see an impact greater than 3-7 basis points on multi-asset or balanced advantage funds. For products like you could say equity savings, which are slightly more conservative, we have seen that the impact there could also be somewhere only about 8 to 10 basis points. So a lot of noise has been on, a lot of negative impact on hybrid funds. I don't think so investors need to worry at all. We've seen that some of the products like aggressive hybrid, BAF, multi-asset, all in the past have been able to generate returns in the double-digit space. And in that sense, if you're able to generate more than double-digit returns, a few basis points will not make an impact at all for investors' returns. Of course, arbitrage funds will take some impact, but yet from a taxation perspective, they remain quite attractive. So investors who want to look at short-term parking can continue to look at arbitrage funds. And maybe like Basant said, some amount of flows can also go back to debt funds because the yields are quite attractive on the debt fixed income side as well. So for investors on the mutual fund space, enough and more options are available. The impact on hybrid funds is not as severe as some of the investors are fearful of. In fact, it's something that they should not be worried at all on. Siddharth, few questions on a lot on gold and silver. So let me sort of combine few questions and sort of ask them. Is it a good time to take about a 20% allocation to gold and silver? That's a question from Avinash. And a question from Sanjeevni, if in case you want to sort of invest, should it be physical gold, silver or ETFs? How would you sort of look at that?
So second question first, it's a bit straightforward. So I think ETFs are should be an out and out preferred vehicle to make investments in gold or silver.
Sure.
Lower cost, no making charges, no issue of safety, purity.
Correct.
And like I mentioned, you can buy and sell on exchange, no issues of liquidity as of now.
Sure.
On the first part, I think right now, investor should maintain their long-term strategic allocation in gold and silver. Don't go overboard. If your portfolio is expected to be in the long term around 15% in gold and silver, then be around 15%. I won't go overboard. Having said that, around 4,400, 4,500 levels, we prefer gold from a medium term point of view. If you're looking for investment, you can look at that. Silver, you have to be a bit more cautious, probably a bit more tactical in terms of taking opportunity of this volatility.
Sure. Next question from Ashish. What's the spread? And this is a question for Basant. What's the spread between SGL and GSEX? Are spreads attractive right now? Also, question is what the spreads between AAA rated corporate bonds and GSEX in the 3 to 4 year category, and what would be the sort of right way to sort of invest in this fixed income market perspective? So Basant, if you can take that question.
Sure. So in terms of the overall spreads between STLs and GSEX, say for example in the 10-year segment, it's broadly closer to 80 basis points. Historically, I mean, if you go back in March, it was closer to 25 to 30 basis points. It went up to close to 40 basis points as well. But right now, I think the fiscal dynamics, like I mentioned in my initial remarks as well, has been quite different as compared to what it was, say, a year or two back. One is that, you know, the duration profile of the borrowing has changed significantly in favor of higher duration. And along with that, what has happened is, say, for example, GST, the impact of overall fiscal impact, maybe 70% of that is being borne by states as against 41% devolution that is going by way of budgetary allocation from center to states. So from that perspective, you know, the fiscal dynamics are continuing to become divergent between center and states, and that is reflective of the spreads that are prevailing. Going forward as well, I think with sort of state elections continuing, expectations of higher CIC and revenue expenditures, the yields might continue to remain under pressure. Even when you start seeing flows by way of index inclusion, I know they've been moved to the second half of the year, but whenever that happens, that will also see an inflow into the sovereign funds and not state development loans. So from that perspective, I mean, while spreads are attractive, if I were to choose between sovereign or GSEC as against SDLs, I would still choose GSEC, because if you look at the last 10-year median spreads between, say, a repo rate and 10-year benchmark yields, close to 105 basis points or so. Today we are trading at close to 170 basis, 150, 55 basis points. So from that perspective, we are already closer to, 40, 45 basis points over and above historical median spread. So as and when you start seeing reversion, I think the 10-year benchmark yields will sort of look at outperforming SDLs, and maybe perhaps when you start seeing flows, while you've seen initial sort of flows coming in by long only funds, but when you start seeing significant amount of chunky flows coming in, you start seeing spreads compressing. I don't mind missing the 5 basis points and then adding on to STLs, but for now I would stick to GSEC as against GSEC between GSEC and SDLs. Now on the corporate bond side, if you look at, say for example, 5-year GSEC with trading close to 645, 650 sort of 650 sort of band, as against say 5-year corporate bonds which are trading in the 730, 35 sort of band. So close to 80 basis points spread there as well. And if you look at historical spreads, I mean, they're easily 20 to 30 basis points over and above median sort of spreads over the last 3 years. So from that perspective, corporate spreads also remain very attractive. But one thing to note is that, when you start seeing bank ALM buying on the sovereign side, they will generally come in the 3 to 5 year segment, primarily because of the change in the HTM rules, wherein banks are not permitted to shift from HTM to AFS or vice versa for more than 5% during a financial year. And therefore, the ability for banks to take long securities and when the interest rate cycles change, make a shift has been significantly impaired. And therefore, whenever incremental demand is coming in by way of, say, credit growth happening, excess SLR is not there with banks, they need to add SLR, then the SLR addition will happen in 3 to 5 year segment. And if you look at the spreads between 3-year GSEC and 5-year GSEC as well, spreads are close to 60 basis points now. And if you look at the 5-year versus 10-year, it's only 25 basis points. So from that perspective, I would, if I were to add on the sovereign space, perhaps on a risk-adjusted basis, 5-year looks extremely attractive. On the corporate bond space, given that, while 730 is a good sort of spread over sovereign yields, close to 80 basis points. But if you look at the 3-year, 3-year is the 60 basis point spread between 3-year and 5-year GSEC translates to somewhere closer to 130 basis points to 135 basis points on the corporate bond side. So therefore, if I were to look at a 3-year corporate bond versus a 5-year corporate bond, perhaps my preference would be on the 3-year corporate bond.
Yeah. Thanks. Thanks, Basant, for sharing this. So we'll take last 2 questions quickly on this one. One question, Puneet, from Puneet, is on the defense sector. And maybe I'll take this question for you, Siddharth. There's been a lot of geopolitical risk, etc., and a lot of flows or news on defense sector. And I know we are recently going to also launch a defense fund. Maybe what's the overall sense on defense and even the spending in the budget as well?
Yeah, so like it has been already mentioned that defense continues to be the key focus area of the government. I think government continues to focus on obviously putting more capex, obviously, so that the industrial production and Atmanirbharta is built more and more on the defense sides in the defense segments, submarines, missile systems, etc. And apart from that, apart from the diversification, there is a reasonable amount of risk aversion also, because if you look at other portfolios, there are a lot of top heavy companies which while they are part of the portfolio, they are not at, let's say, a 20% exposure or so. They are more around 15%, etc. So the risk at a top level is also mitigated. And we expect participation to come from private companies as well as small and mid caps also going forward. So we believe that what has played out in last 3-4 years, we might say more incremental plays from private players as well as small and mid cap companies in the defense space. So that NFL starting from today itself. We'll have a webinar on 4th, which is day after tomorrow. So if anyone is looking to know more about defense space, we'll be covering obviously government outlays, etc. How's the order book looking like? What are the PE evaluations, etc. and our view from a 3 to 5 year point of view in that webinar.
Yeah, thanks for that. So we'll take one last question. This is from Mr. Nayan. Question for you, Gaurav. How do you see IT, pharma and healthcare from a valuation perspective and considering that the recent announcements in these sectors?
Yeah, so let me just write down. First on IT, clearly IT is, at a stage where price, speaking in terms of price wise, there's been underperformance over the last some quarters. However, the nature of these businesses is such that they're qualitatively very sound, huge cash flow generating businesses. Additionally, in context of the recent budget where there's been a rationalization on the buyback front, which removes the friction from buyback as a tool to be used judiciously, for adequate capital allocation / dividend distribution. I think that is a big plus for a lot of these companies who anyway have high payout policies announced. And buybacks actually, when done at attractive valuations related to fair value of those businesses, create value for the remaining shareholders. So the budget has been positive. Valuations for all that space right now related to its own past is also attractive. What is to be looked out for is, of course, the magnitude of growth. The signs are getting a bit better on the margin. At the margin, remember, a year ago, things were anyway looking good, but we had the tariff challenges where a lot of the end customers and corporates, for these IT firms in India, who are domiciled in, say, US and the West, were uncertain, and that led to a prolonged uncertainty on decision making. I think that should start now, clearing up. Of course, there's a separate, challenge or question mark on how AI will play out. But I'm of the view that Indian firms will eventually be required and will participate in implementation of that as well. So net, not just with reference to the budget, but otherwise as well, given the valuations, the quality of those businesses, I have a constructive view. We would typically be neutral to slightly plus minus over it. Especially if growth picks up, then things will definitely start looking better for that space. The next one was healthcare. See, healthcare is a very diverse sector. I mean, so we're talking about diagnostics hospitals at one end, right, to formulation companies with different business models. India, rest of the world, those catering to generics in the West, or some who are doing some specialized stuff in US or biosimilars. But net, I would say that for especially in current times, there's been a correction, say, in the hospital space, and I think that's more a structural, steady growth story. And with the current valuations, having come down, I think that space should give decent compounding returns, double-digit compounding returns, simply because there is a fair amount of scope for the organized sector to continue becoming bigger. Maybe the heady growth of recent years post-COVID might slow down a bit on things like ARPOB, but notwithstanding that, the nature of evolution, tailwinds from insurance penetration, the move up into more complex lifestyle-related treatments and all of that procedures will suggest that and of course the sort of low penetrations yet would suggest that the organized hospital space as a category at the current valuation should be giving compounding returns. As far as the formulation companies, there are so many different models, as I was saying. So for some big parts of the industry, there were some challenges in the recent times because of a cliff on account of a particular product which is contributing very significantly to those to their profit pool. Now that is resetting and will take a couple of quarters. Beyond that, then I think it will be more stock selection. I don't think the budget has talked about biosimilars, biogen, all of that, or clinical trials based in India, but I don't think that moves the needle. The Indian healthcare, the pharma industry in particular, has its own niche, proven both on quality and cost at a global basis. And so I think there'll always be a scope for bottom-up stock selection, but I can't really sort of go down beyond that at this stage. So yes, it's a sector to be looking for ideas for sure. The last sector Vaibhav you mentioned was it was IT, healthcare, and I just missed it. No, IT I covered, healthcare, and I missed the third one actually.
I know we've sort of covered that, Gaurav. So,
okay.
No challenge. Yeah. Thanks, Gaurav, for sending this. And so I think so in conclusion, maybe what we can share is that we hold to have a very constructive view on equities. Budgets are just events which happen and announcements which are there, but you have to long-term look at structural earnings of markets And if earnings growth remains sort of strong, we would expect markets to do well. So we have a constructive view on equities. Like Gaurav mentioned, valuations for large cap look quite attractive, and mid and small cap needs to be part of a core allocation from long-term perspective. So investors can look at various categories like large and mid, multi, flexi, and standalone mid and small cap fund. In fact, our small cap fund has completed a year of very strong performance. On fixed income, Basant really showcased, how the numbers mentioned by the government look realistic. The borrowing should not be that large a challenge, and in the current market scenario, categories like ultra short, money market, and low duration look sort of attractive for fixed income market. On hybrid funds, in spite of the sort of negative flow news that is going around, we don't think that there is a lot of negative impact on aggressive hybrid, multi-asset BAF sort of products. Arbitrage could be impacted to some extent, but it already continues to get the tax advantage. So I don't think so. Investors in hybrid funds need to worry a lot. Siddharth covered outlook on gold and silver, and clearly, it's a stance he'd been mentioning that we had a sort of an underweight or a cautious stand on gold and silver in the past. And now this sort of correction is a good sort of healthy correction for potential investors to invest. They should invest in the right manner, and maybe a gold, silver, FOF could be the right way to sort of allocate. Just to conclude, this is a monthly webinar series. We will try and share our outlook on markets and fund categories that you can look at. Very happy to see a very active participation from all of you and a lot of questions. We couldn't take all of them. Hopefully, we'll take it in the next webinar, as many questions as possible. So thanks for joining us today, and happy investing, and hope to meet all of you next time. Thank you.